Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Marvell technology stock, which today, the last time I checked, was down like 18 or 20%, which isn't showing up on the fast graph. It won't show up until tonight. Ticker here is MRVL. As always, this is not individual investing advice. This is just how I analyze stocks. So let's first start by looking at the historical earnings. Okay, that's the dark green shaded area here on the fast graph, and this goes back 20 years. I do have a 25% off affiliate link down in the description if you're interested in giving fast graphs a try. They have free trials over there, so it doesn't cost anything to just go check it out. But it's really good, especially this phase, I think, of the investing process, because you can look and see what's happened in the past. My experience has been about 80% of the time the past is a good guide for the future, as long as you put a little logic on top of it and watch out for a couple pitfalls, like common things like increasing debt, or there's a few things you have to watch out for. Once you control for those, 4 out of 5 times the past is going to be a good guide for the future. As long as you don't fall for, the stories that this time is different. Sometimes even if it's different, it's not different enough to make much of a difference. So we know that it's not the same today as it was back in 2006 and 7 and 8. But we can also see that during that drawdown, well, let's start with earnings. Earnings fell over 100%. They were negative, and let me shrink the fast graph so we can look at it. The one critique I have is they don't have enough room on here to show each year unless you shrink it down. So yeah, they did fall a little bit more than 100%, so they lost a little bit of money in 2007. And then earnings eventually did rebound. However, what's worth noting here, one of the reasons I don't currently track Marvell is because when we know it's cyclical, one, it's in the semiconductor industry, okay? They're all cyclical to some degree. Usually they're deeply cyclical like this. There are a few exceptions that are, maybe a couple of them are moderately cyclical based on earnings. Now, these earnings did recover quickly, but then they came down again for several years. One thing, you can tell that even though earnings came back pretty quick in this drawdown, they never reached this peak again until 2023, after we had a bunch of stimulus and then AI kind of got in everybody's head. There's actually probably more stimulus than AI. And so you went from 2011 you went over a decade with earnings lower than that peak right there. And the second thing that you can look at when it comes to this is, what did the stock price do? Did it recover this peak in a timely manner? Well, that was $35 a share. It didn't recover $35 a share until we got stimulus in 2020. So 15 years until the stock price recovered its old high. I like that to happen within 5 years. So I wouldn't say that makes it completely uninvestable. I might even buy some if the price is right, but that's why I don't currently track it, because one of my standards is I want this price to recover in a timely manner. Now, there are some situations where you have kind of a super cycle or something like that. This kind of peaky top here probably was some sort of thing like that. And then if that's the case, then you can kind of control for that, and you can almost do it visually here. If you disregard the super peak price, which I'm going to actually talk about later here in a bit. So if instead of taking this kind of blow off top or whatever you want to call it, and we just go to like 2007 where the peak price was, we'll call it $20 a share. Well, now they recover that really quickly along with the earnings. And then usually that's where I would take profits. You make your 100% maybe, and you're good. If you bought when it was 50% off of that, which is $10 a share, which would have happened right about there, right? Not even exactly at the bottom, but you can make your 100%. And that's probably how you want to think about it looking back in hindsight. What's interesting is a similar thing is happening now. And we might be able to take advantage of it as investors. So let's go to, let's go to here. Okay. So the stock is down even more. I think it's down 20%. It was down closer to like $70 a share or something like that when I peeked at it. So we can kind of see that if we look at this period here, well, one, we have this little blow off peak here, which was a bubble. That was the peak of the real bubble. We had a few stocks recently that had to do with AI, especially, or some of the big tech companies that had this second kind of fake peak is what I would call it. I could say that now that people are seeing what's happening. I couldn't really say it before because people just freak out about it. But if we look at this, kind of the real peak was right around here at like $70 a share. We can kind of see right about here it peaked, and then it tried to make a comeback. It failed. I'm not a technical analyst. I'm just pointing out some things that I would look at to try to mitigate the issues with these kind of super spikes at the very end, these kind of blow off top things. So you can kind of see that that's kind of a real peak, still a big one. But we also have it right here before the blow off top, right? Right at that $75 share level, right? And today we're right down, we're probably going to end up down here somewhere. And then when you look back in time, you'll be able to see, oh, that super spike or whatever, just people last minute craziness or whatever. So they reported good earnings from what I heard on Bloomberg, and people just, I don't know, it was the outlook. Look, with cyclicals, they sell off before the news gets bad. Okay, so this is why you can't pay, once you establish it's a deep cyclical business, you can't pay any attention to the earnings, basically. Not when you're trying to value them. Of course, these guys, the earnings were crazy anyway, so it worked out because earnings fell. Might have been less so here, a little bit, like 45, which is still nutty. But putting that aside, I mean, that might have been where they were at back in 2000. Let's see. Yeah, there you go. 45 to 48. Similar kind of peak there. Especially if you go right in. That was when earnings started to fall. That's before they started to fall, right about 45. And so we kind of have these same PE levels being established. Peak, I will call them peak PEs. Being established kind of as a process here. So there's actually a lot of similarities between what we're seeing with the stock price now and the lead-in peak valuation that we had back in 2008. So let's go look and see. So right now the stock is, what is it, down like 40% maybe? So I don't have today's. So it's down almost 30, and then it's down another 20 from here, which would probably be about down 40, 45, maybe 40 to 45% off the peak is my estimate. Since I don't have the daily chart here yet. So let's go back and see what it did then. We have this kind of similar peak. We have a recession that doesn't come until a couple years later, right? So this is kind of a peak here. You could pick either one of them, I think. But I'm going to go right from the top, go down. We'll see how far it fell. All right, so we have an 85% plus decline off the peak back in 2008. Now, a lot of the pushback that I get from my overall cyclical approach from people when I write about it, which I've been doing since 2018, well, that's not true. I've been writing about cyclical investing in this strategy for 10 years, but I started warning people in early 2018 using it. So that was the first time that I wrote. I used to just write buy articles. And then I noticed that things were just kind of crazy over, looking very peaky. Macro was looking tricky, 2018. And I also started doing this full time then. And in January 2018, I just wrote a ton of sell articles on cyclicals and a few others. And these guys, well, sometimes things get dwarfed. So they only fell about 40%. Well, only in a non-recession year, that's a lot. But there were a lot of cyclicals that fell close to 50% just that year until the Fed stepped in and lowered interest rates. But the point that I'm trying to make here is that people will say, well, that was all the way back in 2006 and 2007. We're not going to have another Great Recession, and things are different now. We have a secular growth story in semiconductors and AI and all that and all that. Okay. Sometimes that's true, all right? But fortunately, what 2022 gave us was a very near-term picture on what the market really thinks about that, okay? So we had this 2022 peak and decline over a year. This is almost exactly a year. So this stock fell about 60% in a year with no recession, okay? That ought to tell investors that it's capable and likely, if there is another recession, it will fall 85% again. I mean, the probability is very high. The market's already telling you it doesn't care about this story. Now, the AI story put a bottom in this a little bit. That's the only thing that's changed since 2022. So they haven't even had their earnings actually recover yet. Although analysts still think they're going to. So we'll see about that. Analysts think this until there's a recession, and then they're negative to, maybe not this year, but maybe next year. And then everybody just forgets, because they're too busy panicking. But there's no reason to think in a recession that this stock won't fall 85% again. So what does that mean? Well, let's see. It peaked at 130 almost, looks like this year. And I don't know, what's 15%, of 130, like a $20 or something like that. So we're at 70. What do you have to fall? 70 something. What do you have to fall to get down to 20? Well, you're probably looking at another 75% decline down, I would say. I'm just doing this in my head, but so yeah, the stock's down 20%. Yeah, it's down 40% off the high or whatever. It could still fall another 75% if there's a recession and the right conditions, are met. And if there's not, let's just say we have a repeat of 2022 where it fell 60%. So 60% off of 130 is under 60, right? Maybe under 55. So that's still a long way to go down, even if there's no recession and everything, and we kind of pull out of it or whatever. So it's not a buy. I would consider buying it if it was like 80% off its highs. And what I would do is I would use this, it's probably $75 mark, is my potential selling point. I wouldn't use, when it comes back, I wouldn't use these kind of super peaky tops here. So if you kind of think about that, 75% of its highs, maybe buying it around 30-ish or so. Is that right? 30, 60, 90. Yeah, that's about right. Yeah, like 30-ish dollars a share. And then if it gets back up to 75, you made, 150% return. And you're selling before that next peak. So what that would have translated over here to, which we kind of looked at earlier, if it repeated, you would buy it. Let's see, what did it fall to? $5 a share. Let's just say you bought at 9. That's fine. And then you get up to this level here, which is not the peak. You're not waiting for that because last time it took like 15 years to get there. You just kind of aim right there. You get your 150-ish% return in a year and a half, and that's really good. And now your risk is off the table. You don't have to sit through this whole, churning process over the next however many years, 8 years or something. And you can make a little bit of money. But it's a long way down from here if things keep going poorly in the macro. And so I would be very careful about stepping in and buying the stock right here. All right, sorry for all the negativity, but you know, if you're watching the market today and the past week or two, then you kind of can see that's how things are going. And one of the biggest mistakes you can make with cyclicals is buying them too soon on the way down. You know, if you're buying at 70 and it bottoms at 20, you're going to suffer through a big drawdown, even if eventually you make your money back 5 years from now. And so it's good to look at the past. This near term, I think, is just, that really makes the case. You see what the market thought just a couple of years ago of this stock. You see the freak out that it had. It's probably going to do the same thing, unless the macro changes. All right, if you found this useful, hit the like and subscribe button. I have weekly picks over on Patreon. They were barely positive since October, which is better than the S&P 500. And I started it in October, so I wasn't just randomly picking that date. It's only $25 a month. I have a free tier on Patreon. And I have the full Cyclical Investors Club service over on Seeking Alpha. This is a time, this week has been great for us, really. We're long only, so it's not like, you know, the portfolio is up and the ideas are up, but we're over 40% cash and the market's just kind of coming to us right now. We bought a stock yesterday, so we're going to be nibbling away here, but there's a lot of stocks that are still overvalued, so just sit and be patient and just kind of pick them up as they come along. And, you know, you don't panic as much when your portfolio isn't falling as much. And you have a nice balanced portfolio, which is what we've been building over the past few years now. So thanks for watching, and I'll see everybody later.